We just saw a massive decline in inflation, but how is that going to affect interest rates? How is that going to affect your pocketbook? Ultimately, that's what you want to know, right? With inflation coming down, does that mean we've avoided a recession? Well, in today's video, we're going to talk about the idea of a recession. We're going to talk about the Fed's potential pause, their pivot, how that's going to affect interest rates, how that's going to affect your buying power, and ultimately what you're likely to see over the next couple of months with regards to inflation, with regards to interest rates, and ultimately how that's going to affect the housing market. This past week, we saw the Consumer Price Index, the measurement of which consumers pay for goods and services, rise just 6.5% from a year earlier. That's down from 7.1% in November, and well below the 9.1% peak that we saw back in June. The core CPI, which excludes food prices as well as energy, and the primary measurement that the Fed follows with regards to inflation numbers, increased at an annualized rate of 3.1% in the 3 months ending in December, which is the slowest pace we've seen in more than a year and down from the 7.9% that we saw in June. So is inflation really over? Well, we just had our first deflationary month. We saw prices decrease by 0.1% month over month. And if we look at this chart here and we annualize the past 6 months, then we have an annual rate on the headline inflation number sitting at 1.8%, which is below the Fed's target of 2%. On top of that, we have some month-over-month replacements coming in shelter, which should start to reflect in these numbers in March, which seems possible that we've seen the worst with regards to inflation and that there's a possibility that we could hit the Fed's target by midsummer or later this year. On top of that, we have the Fed's Harker ready to downshift to just 25 basis point hikes. Last Thursday, he said, while the central bank needs to raise rates more to cool off inflation, it can probably do so at a much slower pace compared to the action of last year. He goes on to say, I expect that we will raise rates a few more times this year, though in my mind, the days of raising them 75 basis points at a time have surely passed. He goes on to say, in my view, hikes of 25 basis points will be appropriate going forward, which is more or less confirmed by looking at these charts. As you can see here, interest rate traders are pricing in a 94% probability that the Fed is going to slow the hike of interest rates in February to just 0.25%. Also pricing in a 74% probability that you're going to see another 0.25% in March. But the biggest difference that you're seeing in these 2 months is that in March, you're also seeing 16% of interest rate traders out there actually predicting that the Fed would pause at that time and not hike interest rates any further, which is ultimately something that we haven't seen over the last year at all. But here's the real kicker. There's actually 33% of interest rate traders out there actually expecting a rate cut as we head into November. And the primary reason for this is because there's a lot of people out there that believes the Fed has gone too far, too fast, just like the Fed did 2 years ago when they were doing quantitative easing. They were buying mortgage-backed securities. The government was giving out stimulus checks everywhere while calling the inflation transitory for way too long. Well, now they've let the pendulum swing the other direction. Yes, inflation is out of control. Yes, that is one of the primary jobs of the Fed is to control inflation. But what you've seen is a very aggressive Fed, hiking Fed funds rates 75 basis points multiple times without taking a second to pause and give their quantitative tightening an opportunity to work. They continue just to pile on the hikes over and over again until ultimately something breaks. And there's a big percentage of people out there that believe the Fed is going to break something, and that's ultimately why 33% of traders are actually expecting that rate cut sometime in the later part of 2023. So what's the likelihood of a recession? Well, one of the most closely watched indicators is actually signaling a recession ahead. And that signal is the Treasury yield curve on the 2-year and 10-year, which is currently sitting at the lowest level in nearly 40 years, ultimately signaling that a recession is ahead. So the question is, why hasn't the Fed paused? Why haven't they changed their language out there? If inflation is coming down, if economists out there are thinking that the market is going to get rocked due to these rate hikes. Now, before we dive into that, I want to take a minute and ask that you smash that like button if you find any value in these videos at all, and feel free to subscribe to the channel to stay updated on everything interest rate and housing related. And the primary reason is that the economy looks to be resilient. While job and wage growth have slipped a bit, they still remain above the Fed's target at a time when jobless claims have actually started to edge down. Well, the primary reason I believe that the Fed is not coming out changing their language at this point is because, one, they want to get inflation under control. They don't want to stop too soon. They don't want want to have a repeat of 1981 when, the Fed paused and inflation went out of control. So they want to make sure it's under control. And at the moment, the measurements out there are reflecting that. If you remember back in September, when Fed Chair Jerome Powell was asked to clarify what he meant when he said spiking mortgage rates would cause a housing reset, the meaning, he said, was that the U.S. housing market would slip into a difficult correction. He goes on to say, when I say reset, I'm not looking at a particular specific set of data. What I'm saying is that we've had a time of red-hot housing market all over the country where famously housings were selling to the first buyer at 10% over the ask even before seeing the house. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a more reasonable level and at a reasonable pace that people can afford to buy houses again. So I think if the Fed came out and said that they were thinking of pausing, thinking of pivoting, thinking of doing anything other than what's already built into the market, that could front run the market, right? Traders out there, home buyers out there would ultimately get the impression that the Fed is going to change their stance in the future, and that could ultimately bring rates down even further. And so what they don't want to do is front run this information. They want to allow it to take place as the data continues to show progress. Now, where do I think interest rates are going? A couple of weeks ago, I did a video where I talked about mortgage rates, and I said that I thought you could see a 30-year fixed rate somewhere in the 5% range by the end of Q3. And I still believe that. Now, I made clarity in that video saying I don't think it's going to be at 5%. I think a 30-year fix would start with a 5. So that could be a 5.75 rate. It could be a 5.9% rate, whatever. But I think interest rates could start with a 5. And what we saw after the inflation data came out is we actually saw the 10-year come down and we saw 30-year fixed rates improve. In fact, as of today, a 30-year fix is sitting on average around 6%. So ultimately, we're not very far from that 30-year fix starting with a 5. But with that said, I don't think you're going to see any major improvements in interest rates over the next couple of months. I think you're more or less going to see interest rates trade in this range, somewhere between where they are at the moment to somewhere in the mid 6% range. And the reason for this is because the Fed isn't going to pause. They're not going to pivot. They're going to do exactly as the market has expected, which means that they're going to come out in February and they're likely going to raise 0.25%, and then they're going to come back in March and likely raise 0.25%. While keeping their hawkish stance on the economy, while keeping their poker face and not letting on that they could actually pause sooner than they originally mentioned. So what does that ultimately mean for housing? Well, we just got the most recent data that shows that pending home sales are sitting at the lowest level we've seen since 2015. And at the same time, we've actually seen consumer confidence rise because home prices have pulled back. And while interest rates have dropped to the lowest level we've seen in 4 months, they're still significantly higher than they were just a year ago, which is putting a strain on housing affordability and causing buyers to cancel at a rate that we've never seen before. KB Homes, one of the nation's largest home builders, saw a 68% cancellation rate in December. And this is primarily due to affordability. It's primarily due to concerns that the market is going to continue declining. And I'm not going to go out there and say it's a great time to buy a house, because it's not. It's not a great time to buy a house. A great time to buy a house was 2 years ago, 3 years ago, prior to COVID. But with that said, I also don't believe that you're going to see housing prices crash. I think the more likely scenario is that you see home prices continue to moderate while interest rates continue to improve slightly, not significantly, which is ultimately going to help affordability, but not in the way a lot of people out there want to see. I think the likelihood that you see home prices go up is very, very low. I think the likelihood that you see home prices crash is very, very low. I think the likelihood that you see home prices move sideways, slightly down, maybe slightly up in some markets is ultimately more realistic. So if you're planning on buying a house, just make sure you're buying for the right reasons, you have that longer term time horizon, and ultimately you have money in the bank. Just in case you get laid off, just in case something happens, you're not stressed with having to make that payment. Because at the end of the day, there is a real probability that you could buy a house and prices actually go down below where you purchased that property. But with that said, I think timing the market is extremely difficult. So for most people out there, they shouldn't be concerned with that. They should be concerned whether they're buying for the right reasons and ultimately whether the payment makes sense or not. Now, earlier in the video, we talked about the idea of a recession. We talked about the idea of the Fed going too far and breaking something. So I wanted to end on this slide here. This is a roadmap of 2023. And this graph actually shows the 3 most probable paths for the Fed in 2023. As you can see here, the green line tracks the Federal Reserve's guidance for the Fed funds rate. This is ultimately where they expect to be by the end of the year. The black line charts investor projections as implied by the Fed funds futures, which actually shows that a large majority of the traders out there don't believe the Fed's going to hit that 5.25%, or if they do, they're likely going to do some sort of interest rate cut in the future. While the last line, the red line, actually shows what happens if something breaks. And there's some people out there that believe that the Fed could end the year at a 2% target rate by the end of 2023. Now, I don't believe that. I think the more likely case is that you end somewhere around where that black line is, but I thought I would show the chart to get your thoughts. So let me know what you're thinking in the comments below. Where do you think the Fed is going? What do you think they're going to do with the Fed funds rate? How do you feel like that's going to impact housing? Are we going to be in a recession? Do me a favor and let me know in the comments below.